based on a DW News podcast between Daniel Winter and Joe Chastain regarding the core economic narrative of 2025 is the deepening of a K-shaped economic reality where the financial trajectories of the wealthy and the less wealthy starkly diverge. This split is fundamentally driven by asset ownership. The top 10% of households who own 63% of U.S. assets thrive in a global asset boom. High interest rates, intended to combat inflation, benefit them through higher yields on cash and steady home appreciation. Their wealth is insulated from local inflation, tied instead to a buoyant stock and real estate market. Conversely, the bottom 50%, owning just 5% of assets, bear the brunt of inflation while carrying most floating rate debt. For them, a 2% rise in grocery prices is a meaningful hardship, not a statistic. This economic divergence has cleaved consumer spending. Retail data shows a consistent, moderate decline in brick-and-mortar traffic and sales for mass-market retailers, while luxury markets remain relatively resilient. Consumers in the lower wealth bracket are financially constrained, leading to more intentional, value-driven purchases and a shift towards discount outlets, deep sales events like Black Friday and buy now, pay later services. In response, corporate strategies have bifurcated. Companies like LVMH and Target are abandoning a unified middle-class approach. Instead, they split their models, offering premium tiers for the asset-owning class and value-focused tiers for paycheck-reliant consumers. There is discussion on whether retailers are reducing product quality, for example, using more synthetic fibers to protect margins as costs rise. While part of a longer-term fast fashion trend, increased tariffs and inflation may accelerate this. The key challenge for businesses is not that non-wealthy consumers disappear, but that they become less profitable, forcing retailers to employ heavy discounting or absorb costs to retain loyalty. The sustainability of this K-shaped economy is in question. If the spending power of the lower end continues to erode, even robust high-end consumption cannot compensate for the broader retail slump. The primary barrier to improvement is staple goods inflation, particularly groceries, which consumes a growing portion of household budgets and depresses discretionary spending. While job security currently provides a floor, consumer sentiment for 2026 is pessimistic, with expectations for stable or worsening prices. Key trends to watch include the slow, consistent decline in store traffic, partially offset by online shifts, the rising influence of social media and AI-driven shopping tools, which will increase competitive pressure on brands, and the critical factor of grocery prices. Analyst Joe Chastain concludes that for retail to recover and for the wealth gap's pressure to ease, core inflation must recede to free up consumer budgets for discretionary goods. Until then, the economy remains effectively portfolio-driven for the wealthy, while the majority navigates a local debt trap.